Welcome to this explainer. Today, we're diving into the curvature of credit to totally demystify bond convexity for CFA candidates and investors alike. Look, if you've ever felt like fixed income math is just way too abstract, or if you're staring down your CFA Level 1 prep kind of wondering how to intuitively grasp these concepts, well, you are in exactly the right place. We're going to take those dry formulas right off the page and drop them into actual market reality.
Okay, let's quickly hit our roadmap for today. We'll be covering why duration just isn't enough, convexity as speed versus acceleration, the callable bond trap, a real-world case study on Indian rate cuts, and we'll wrap it all up with an exam summary and some pro tips.
All right, let's jump right into Section 1, why duration isn't enough.
To really get convexity, we first have to respect the limitations of duration. You see, duration gives us a linear approximation of a bond's price change. It's what we call a first-order effect. Imagine drawing a perfectly straight tangent line right up against a curve. For tiny, incremental little changes in interest rates, that straight line, your duration, is actually a pretty good guess of where the bond's price is going to go. But here's the catch. The actual relationship between a bond's price and its yield is a curve. It's not a straight line. That means as yield changes get larger, relying purely on duration eventually leads to some pretty massive estimation errors. You're essentially trying to drive straight while the road itself is bending. So this brings up a very fair question. If we already have duration, why on earth do we need to complicate things with convexity? Why add another formula to our plate? Well, the answer comes down to market reality. Financial markets don't just move in tiny, predictable little baby steps. We see huge macroeconomic shifts, massive rate hikes, certain rate cuts, and when those big shifts happen, a straight line estimate isn't just slightly wrong. It can literally be dangerously off. Let's move on to Section 2, convexity, speed versus acceleration. Put simply, convexity is the curvature adjustment. It tells us exactly how much our duration estimate is missing the mark when yields change significantly. It's the second-order effect, the second derivative of the price-yield relationship. So while duration is busy drawing that straight line, convexity comes in and literally bends that line to match the actual real-world curve of the bond's price. It tightens up the accuracy of our price change estimation, giving us a much more faithful picture of how that bond will behave out in the wild. And I love this analogy because it just hits the nail on the head. If duration is your current speed, convexity is your acceleration. Think about driving down the highway. Duration tells you that you're cruising at exactly 60 miles per hour. That is your linear speed. But what happens when you stomp on the gas pedal or slam the brakes? Your speed changes, right? Well, convexity is that rate of change. It's the acceleration. It tells you how your bond's sensitivity to interest rates is changing as the interest rates themselves are moving. So here's the absolute crucial point. Investors love high convexity. They are obsessed with it because it creates this beautiful asymmetric win-win scenario. Because of how the price-yield curve bends outward, a bond with high convexity will actually gain more in price when yields fall compared to what a straight-line estimate would tell you. And on the flip side, that exact same bond will lose less in price when yields rise. You get amplified upside and cushioned downside. It is basically a structural superpower in fixed income. And for sure, it's exactly why higher convexity is intensely sought after by savvy investors. Which brings us to Section 3, the callable bond trap. Okay, so everything we've talked about so far assumes positive convexity. That's what normal bonds have, where the price curve bends outward, giving you that theoretically unlimited upside we just praised. But callable bonds exhibit negative convexity. And listen closely because this is a huge trap for the unwary. With a callable bond, the issuer has the right to buy the bond back from you if interest rates drop. So as rates fall and your bond's price starts to rise, bam, it hits a ceiling. Your price gains are strictly capped because the issuer is just going to refinance their debt. You take all the downside risk if rates rise, but you're totally robbed of the amplified upside when rates fall. This makes callable bonds uniquely risky. And let me tell you, it's a favorite trick for exam writers to test you on. Let's ground this in Section 4 with a case study, Indian rate cuts. Let's anchor this in a real scenario. Imagine the Reserve Bank of India announces a major reduction in interest rates to stimulate the economy. When the central bank slashes rates, it sets off this mechanical chain reaction. First, bond prices naturally rise across the board. Second, bonds with long duration benefit more, simply because they have a higher sensitivity to those rate changes. But here is the kicker. That chain reaction heavily favors very specific bonds. The bonds with high convexity don't just rise, they absolutely supercharge those gains. Think of it like a giant puzzle that the big players have already solved. Bond B, with high convexity, massively outperforms Bond A, even though both of them experienced the exact same drop in interest rates. Bond A's price goes up moderately, sure, but Bond B, because it's acting with that acceleration factor we talked about, its price arcs upward significantly more. This right here is the exact reason why institutional investors actively hunt for convexity during market shifts. Trading desks literally build complex models just to identify bonds like Bond B before central banks make their move, making sure they capture every possible ounce of upside. Let's bring it home with Section 5, Exam Summary and Pro Tips. Here is your core exam-oriented summary. I want you to burn this mental map into your memory. Duration equals linear price sensitivity. Convexity equals the curvature adjustment, and high convexity is always structurally better for investors. If you can quickly map these concepts in your head, you are going to absolutely breeze through those tricky conceptual questions. To dominate your exam, follow this quick checklist. 1. Focus heavily on the difference between positive and negative convexity. Remember, test makers love to use callable bonds to trip you up. 2. Keep in mind that convexity's true value shines during large yield changes. For tiny little shifts, duration is mostly fine, but large shifts demand convexity. 3. Never ignore it when evaluating long-term bonds, because a longer maturity greatly amplifies these effects. And 4. Rely on your visual graphical understanding. Practice those conceptual multiple-choice questions until the curve is just second nature to you. We've moved from the abstract textbook math to the concrete reality of how bonds actually behave when the pressure is on. Convexity isn't just some secondary, throwaway formula. It is the secret engine of bond performance during major market shifts. So I'll leave you with this final thought to ponder as you study or plan your own portfolio. Are your bond investments just driving with speed, or are they accelerating with convexity? Thank you so much for joining this explainer, and happy learning.